Hi there. Thanks for tuning in. Today, we're going to take a look at American Axle and Manufacturing, ticker symbol AXL. And what do? They create drive lines and drive trains. So that's what they manufacture. Those go in engines, those go in cars. And yeah, that's what they do. However, these are also for hybrid and electric cars. So don't think that they're just doing it for regular combustion engines. They're also doing it for hybrid and electric vehicles. So I don't want you to think immediately, oh, this is a legacy business. This is a business that has been around for a while, but is adapting to the world, really. And so $6.1 billion 2023 sales. They're a smaller company, honestly, in 18 countries. They're not the biggest out there. It makes sense. They're doing something very specialized, of course. Anyways, let's take a look. So, their full year sales. So, for 2024, they're targeting pretty much a slight increase there. Their EBITDA to be pretty healthy and their free cash flow to also be decently healthy. So, yeah, these are based on North American light vehicle production. So, of course, the great thing that this depends on is how many vehicles are being produced. If there's a lot of vehicles being produced, they get to sell their drivetrain parts to them. If not, then that will change for them a lot. They are probably a little more affected by economic downturns and demand for cars than similar companies or companies in different industries, is what I mean. So they're a little bit more sensitive to changes like that. Vehicle production in general doesn't mean vehicle sales per se. It just means that they forecasted a certain thing and they're producing. So, yeah, they're going to be sensitive to it. You have to actually take that into account if you invest in this company. Okay. Now, they are a company with a whole lot of debt. A whole lot of debt. Their revenue was 6.1 billion. Now they have about 2.7 billion dollars in debt. So it's quite a healthy chunk, honestly, especially when you compare it to this EBITDA or even free cash flow number, because free cash flow is really what you have to pay down the debt. So it would take about 10 years of the current free cash flow levels to pay down the debt, maybe even a little more. So this is no joke, honestly, even though they have been since 2017 that their debt jumped up to almost $4 billion. Now they've been deleveraging. That's good. So we want to keep seeing that. We as investors are negatively affected by debt because it's less cash that they will have available because they're either paying down the debt or paying down interest on the debt. And that means that there's less they can do with it at the end of the day. Okay. So here's the 10-year history of their sales, their net income, and their free cash flow. As you'll see, the sales, they did jump in 2017 with the acquisition that they made along with the debt that they used to buy that acquisition. However, the net income hasn't really followed that much. They made more net income in 2014 through 2017 than they've done recently. Free cash flow, however, has been decently consistent, so we do like to see that. But we want to invest in a company where positive free cash flow doesn't just come from depreciation and amortization. We want it to come from the fact that they're actually making money somewhere, that someone is paying them somewhere. And that does translate to what they get at the end of the day in hard cash money to utilize, of course. Here, we're talking about total assets and total liabilities. So even though the debt is pretty chunky, pretty significant, at the end of the day, their assets are still more than their liabilities. But yeah, the debt you see, this acquisition basically made them acquire a bunch of debt. Now they've been working it down. The net debt is not great, but is it critical? Well, not necessarily. It does keep their net income a little bit weird, which is what we're about to see, but they can definitely manage it for now. You know, yeah, they don't have a lot of net income right now, but at least they're not consistently negative. They seem to be able to pay it off little by little. So here's how it actually affects the net income. So here's what you get as operating income, right? Well, after you make a piece and pay for all the costs and then pay for marketing, pay for SG&A, pay for research and development, what you have left is operating income. So in general, they have operating income every single year. But then you have net interest expense. That's how much they spent paying just interest on their debt. So as you'll see, most of this in recent years is has been taken out of operating income immediately. So yeah, you have your income, then you adjust it with interest expense and a few other expenses, and then you get net income. So now you understand why, for example, in 2020 and 2023, net income was pretty much none to negative because the interest on the debt is high enough that it's shaving it off the operating income. This is why this high amount of debt is a problem. I do want to do an analysis on it, however, and it does have very consistent free cash flow numbers. So I think it's pretty nice because we can just say, okay, it's going to keep growing at about 2.5% per year. And we're just going to do that with a required rate of return of 11%. We're going to say that about like 4% of the revenues get turned to free cash flow, pretty much just keeping it in line with previous free cash flow numbers. Nothing too crazy here. And then with this discounted cash flow model, if we just plug it in, we and divided by the total number of shares out, we get a fair value of $25.09. However, that's not a fair number because we've been talking about the debt, so we have to adjust for the debt. Their net debt is about $2.3 billion, and then the value post debt is $5.35 per share with this net debt included. Now let's look at where the stock is right now. And yeah, I mean $5.76, which is decently close to this prediction of $5.35. If there's a few things that are different, for example, if they grow for more than expected, then yeah, you could argue that this value is pretty representative. Maybe it could be worth a little more, but yeah, if you own the stock, you're not very happy with it, and it's gone nowhere, just like the income has gone nowhere, really. In fact, this is probably the best point to buy it, and even then, I wouldn't enthusiastically recommend that you buy it. Right? The market cap is $677 million, so it's a very small company, but the debt is so much more than the market cap. That's always just something to watch for, really. So even though right now it's close to a 52-week low and it looks visually, if you look at the chart, like a pretty juicy opportunity, I would exercise caution. It's because it's a risky business. It's a great example of how super elevated levels of debt can hinder everything in the bottom line and in the cash flows, makes any form of shareholder returns very unlikely. If they can't pay their debts, or they're too busy paying debt rather, they're not going to buy back shares. In fact, they've been diluting shares significantly, and they're not going to give you a dividend. It's really unlikely. Free cash flow generation, however, is consistent, so I do think they'll be able to keep chipping away at the debt slowly. That means that either if it drops a lot in price, or if you look at it in the future and they have a lot less debt, this could be a very interesting investment if they're trading at a very similar level. However, in current conditions, I would say that the risk and reward is not asymmetric. You're taking on a lot of risk for potentially not that much reward unless something significant changes with either the debt levels or the income levels. And that just needs a catalyst of some sort that I'm not sure is quite there yet, especially given the fact that vehicle sales don't seem to be booming as much as expected. So that's something important. And there's another risk factor right there, which is the sensitivity that it has to this general auto manufacturing sentiment. So in general, I would say it's just too risky of a business to invest in right at this moment. Debt always comes due. That's the lesson I have here. You really just have to pay it eventually. And if not, you'll be paying the interest on it while you try to chip away the most you can. That always hits your bottom line. So, this is something that has to be taken seriously, and we're taking it seriously in this analysis. Thank you so much for watching. I really appreciate it. If you want more videos like this, don't forget to subscribe and hit that notification button. I really would appreciate that. Thank you so much again, and have a great rest of your day.